Welcome to this at-home edition of the Stock Play of the Day. Today's symbol is GOLD, Barrick Gold. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsey, we've had a couple of weird Mondays the last month, I must say, but today we're actually seeing a little bit of red in the marketplace. Warren Buffett had some interesting comments over the weekend, but what are you seeing happening in the markets as I pull up the S&P 500 index chart?
Yeah, you got a little bit of red in the Dow and the S&P 500. Of course, Warren Buffett's comments over the weekend are really weighing down the airlines this morning, most of them down in the double digits. So he sold out of his exposure to the airlines, saying times have changed and he's not sure that the airlines will be able to get back to where they were pre-COVID crisis. So he's bailing out, putting pressure on those stocks, but the overall market too, I think is feeling a little more uncertain this morning. Also, tensions with China rose over the weekend too. So we're kind of getting back to that conversation that drove a lot of price action over the course of the last year. So we got a little pressure in the major indices. One thing is the NASDAQ is in the green so far this morning, to a small degree, but I think, to me, this is just really telling us that there is uncertainty in the marketplace and investors continue to flock to the stocks that they know, these, growth, secular growth stories that they believe in. Most of them reported earnings, at least the FANG names reported earnings last week. And they showed their ability to be resilient in this uncertain time, in this slow economic environment. Many of them also have really strong balance sheets. So that's where investors continue to flock. And I did do a double check of what the FANG stocks specifically were doing this morning. And it looks like all of them are in the green, except for Google, which was our stock play of the day last week, Brian. But that was a stock that we suggested might pop on earnings, and that's exactly what it did. It was up 9% after reporting, almost 10%. It's coming off a little bit this morning too, but nothing to be alarmed by. Regardless, overall, the market this morning just feeling a little pressure. Also, I'd point out that some economic data out of Europe was pretty weak. We got European PMIs, and they reached all-time lows, I believe, in Germany, France, Spain, and Italy. So that was for the month of April, which is a pretty tough month for Europe as they remained on lockdown. As we, this is why I think the trade that we're doing today in Barrick Gold, GOLD, is so important, because there's going to be continued weakness in the economic environment.
Let me bring up, here's Barrick Gold chart.
Yeah, well, I was we'll get to this chart in a minute.
Okay.
But I just, I think this is really a great security to talk about in these times with economic data being so uncertain, and really the market trading off of technicals. Is the S&P 500 that you're showing here. You have those Fibonacci lines back up. It feels like the market, I don't know how you feel about it, but I feel like the market might be a little choppy here as we move forward, as there is a lack of clarity about what the road to recovery is going to look like for the U.S. economy. We're trying to learn from what has happened in China and what is happening in Europe, and we have a lot of states starting to open up or relax shelter-in-place restrictions to get us back to our new normal. I don't know. What do you see the technicals? Also, the VIX, by the way, Brian, you keep a really close eye on that. It's moving higher today, but still below 40. What do you make all the technicals driving the market?
Right. So like we look at the chart, we do see and if I put my mouse over the chart, it highlights the Fibonacci numbers. And we had that retracement where the market came up to the 50% level, made 50% of got 50% of the way back from the big downturn. And now that's actually providing a little bit of support here. We came down, we've touched that level. We're kind of hanging around there. If anything, there's just a lot of chop in the marketplace. Now, the VIX being below 40 to me, and I've mentioned this before, we've used the phrase that 40 is the new 20 in the implied volatility level. 40% implied volatility is extremely high, but we are around 38. Considering what Warren Buffett had, his I guess, tone when he was talking about the markets over the weekend was a little bit scary, I would say. He was trepidatious, and he picked his words wisely, as he usually does. But overall, we're not seeing the big run up in the implied volatility, which a lot of people refer to as the VIX index. So I think the VIX hanging around 38% is kind of a good sign overall, but obviously the airlines, as you mentioned, they got hurt real bad. And I do think that because of the environment, a lot of people are wondering, is the rally over? Excuse me, is the rally over after the big run up to the 50% level? You do notice from looking at the chart too that we did come up and just touch the 61.8 Fibonacci number. And it's kind of weird how technicals are playing such a big, well, what am I trying to say? The technicals are such a big deal in the marketplace now. I guess everybody's really looking at it because fundamentally it's kind of hard to say, well, where are we going to come out on the other side of this? So a lot of people are looking at the technicals, and we see that we're trading right in between that 61.8 number and that 50% number. We got the VIX below 40. So it's not all bad. Obviously the airlines are really getting beat up mainly because of what Warren Buffett said over the weekend. So let's get on to Barrick Gold, GOLD.
Let's do it. Yeah, the market's definitely being technically driven. This is a stock though. Look at that momentum, Brian. You can see this is a 3-month chart, and basically the most recent low for this stock was March 13th, around just over 15 and change. And it has moved about 75% higher since then. Today trading at looks like 27 bucks and change. On a year-to-date basis, it's up 45%. So sometimes it can feel a little scary to get positive on a stock that looks like this, but momentum is usually a good thing for a stock going forward. So we view that as a positive. But like I said at the beginning, the great thing about Barrick Gold is it's a gold miner. And sometimes when we think about miners and gold, Brian, you and I talked about gold commodity at the very beginning of March. And we were positive on the commodity at that point in time. It's GLD has moved 8% higher since we had talked about it last in early March. At that point in time, I wasn't very ready to get, and you see that with the beginning of March here in this chart. I think I said in that stock play of the day video that I wasn't sure that we could really get excited about the gold miners just yet, because the problem with the miners is they carry that equity risk. And I think since then, it was April 9th that the Fed really took a big stance in how they were going to be able to help support the market and the functioning of the credit and equity markets going forward. And since then, I think that has taken a little bit of that equity risk off the table for the gold miners. While there's still a lot of uncertainty in the equity markets with regards to fundamentals, I think the moves by the Fed and also the U.S. government putting unprecedented amounts of stimulus into the system help support a gold mining stock like this. So that's a positive for the gold miners for sure, removing that one bit of risk. But there are some risks to stocks like this, and that includes the potential for inflation getting a little heated. If inflation gets heated, this is the best place you want to be. The dollar is what I was really thinking about. The dollar has remained strong, and it's having a hard time coming down given the weakness that we're seeing in other parts of the world. So that can work against not only the commodity, but also stocks like this. Another, negative could be reduced demand from India and China as they make their way through the crisis. There's going to be less demand from consumers there for gold as they reevaluate what they're spending their money on. But when we think about Barrick, one of the most impressive stories there too is for actually all of the miners is the price of oil. And we've been talking about that too, Brian, because we've been seeing unprecedented moves in oil into negative territory. I know you put a note out to our customers on that a couple weeks ago when that happened. But oil prices still remain very, very low. And even if you look at the futures contracts, there's not there's not much expectation for the price of gold, at least for WTI, to get above $30 into the fall. And that's a very good thing for gold miners because that's one of their biggest cost inputs. So low oil prices is very good for these guys. Additionally, Barrick is an interesting name because if you look at their balance sheet, they've done a really good job over the last 3 years in right sizing their balance sheet. Even though they've done a big acquisition, their debt to equity ratio has come down from 77% 3 years ago to about 18% now, and their interest coverage ratio is 7 times versus 4 times 3 years ago. So that's really a big deal in this uncertain market too. You hear everyone, especially pundits on TV and that, talking about how you want to be in high quality names. Well, these guys actually have a solid balance sheet, making them higher quality than you might expect from your traditional gold miner. So those are the pros, those are the cons. We think that there's momentum though behind this stock, Brian. So what's the trade that we should do from an options perspective if we like the momentum we're seeing?
Well, definitely. So let me go back and share my screen again. I'll show you the Ally Invest live option chains. Let me make my screen full here. Inside the option chains, we see here's where Barrick Gold is at right now. It's up 31 cents on the day today. It's up about as much as the spot gold relative. And we see it's at 27.24. Now, the earnings have already been announced, so we don't really have any headwinds that we're concerned about. But if I look at this underlying stock, we have decent implied volatility overall. In the marketplace, implied volatilities are a little bit high. So I'm going to look at a stock play today that's a long call spread. We're going to go out a little bit further in time. We're going to go out about 45 days, and we're going to look at buying a little bit in the money option contract. That'll be strike A here that we see inside the options playbook. And we'll be selling an out of the money option contract, which would be strike B here in our long call spread inside the options playbook. So when I look at a stock like this, though, we still got volatility. And overall, if the expiration that I chose here is the June 19th expiration. And as always, these aren't meant to be recommendations. We're just trying to learn here on stock play of the day. But if I look at this, I see the implied volatility even going out to June is around 52% implied, which in this market environment, that's not too crazy relative. I mean, back in the day, that would have been an extremely high volatility, but now it's just a little bit more on the normal side. So I think about this when I look at this. I also think about maybe just buying the stock. It's a $27 stock. To buy 100 shares of it, it's going to cost you $2,700 plus commission to do it. But if you'd like to do the options, and the biggest thing about the options is that we're going to minimize our risk. We're going to know exactly what our risk is going into the trade. I would look at going out longer term, buying a little bit in the money. We're going to buy the 24 strike, and this is the call chain, 24 strike call with the June 19th expiration 46 days away. Now I'm going to pay attention to the price of the put. If I look at the price of the put, this is the put chain over here, we're seeing that that's trading for about 73 to 78 cents. So if I have a high volatile environment, first of all, like I said, you might want to think about just buying the stock. It's a fairly low price stock, or you want to pay attention to how much time premium you're actually playing with when you're trading your option contracts. So what we're doing here is we're going to try to buy an option that has about, I'm going to call it 75 cents worth of time premium. And if I just look at the put, that gives me, it's a quick and dirty way to figure out the approximate time value. The price of the put will be about the time value of the in the money call option. And then I'm going to scroll down and just look at the 31 strike call. So in this instance, the 31 strike call is trading for about 77 cents on the bid. So we'll call it 80 cents. So in this scenario, we're actually selling more time premium than we're buying. What does that mean overall? That means that if implied volatilities fluctuate quite a bit, or we get some heavy time decay because we're paying up for these options in this environment, that we're going to have just as much time premium that we own as the time premium that we're selling. So that basically removes that time decay, that implied volatility risk, because we're approaching it where we just want to deal with the price of the stock. We don't want to deal with the headaches of an option contract. And one of the biggest things about just buying an option outright is trying to deal with time decay and implied volatility fluctuations. So that's why we chose a long call spread today. So let's go and look at the trade and talk about the risks. This will be the paper trade for this week. We're buying the 24 strike call, selling the 31 strike call. So the maximum that a long spread can get is the width between the strikes. So 31 minus 24 is 7 points. Looking at paying $3.18. It was around $3 when I was looking at it before the call here, but $3.18 is the midpoint here. Can't always guarantee a midpoint fill, but you want to try to work your order somewhere in that range. We'll call it $3.20 just to make the math simple. Okay, so $3.20, that's $320 for every 1-by-1 spread that we do. And don't forget to add in commissions. So on paper, our total risk would be $320. And then you take 7 minus 320, and then our upside here is $3.80 on the upside. So we're kind of managing our risk here in that we have more upside than we do downside. We're buying about the same amount of time premium as we're selling. And we're basically saying, if I scroll down to the LI Invest profit and loss graph, we're basically saying that we only want to play with the stock in between the strikes. So from 24 up to 31, we see that we have risk, we have reward in that area. Below 24 on down, our profit and loss graph says the maximum we can lose is at $3.20. And on the upside, we have limited and known upside. Above 31, we don't have any, our profit potential goes away. So this is what the profit and loss graph, the colored line looks like today. And this is what it looks like at expiration. Now, the only thing about this long call spread is we're a little bit more longer term bullish. Obviously, if we can get all the way up to 31, that's a pretty good move in Barrick Gold, but we're giving it time to play out. That's a 45-day time period. So when you're doing long spreads though, and I'm gonna reduce my time period down, let's go down to about 3 days remaining. And I'm just gonna do that by saying days to go. Now you see that the colored line starts to morph with the dotted line, which is the profit and loss at expiration. So one of the big things about doing a long call spread, this is a little bit of a pain with them, you get this benefit of the slow rate of time decay, no real concern about fluctuations and implied volatility in the price of the option contracts, but you really need to move to be closer to the expiration date in order to get the maximum out of your forecast if you are correct about where you think that underlying is going to. So that will be the official paper trade for the week. And I'm going to put this in the right rail over here. Let me scroll down a little bit here. And there's the profit and loss graph. And we'll make it 320 is what we talked about. So we're going to make that the limit price. It'll be a net debit to the account. That'll be the maximum risk. Buying the June 31, or I'm sorry, selling the June 31 strike call, buying the June 24 strike call, net debit of $3.20, and that's the paper trade for this week. All right, Lindsay. Well, last week we did have a couple of questions in the chat box, and it's important to let you know that if you have questions on this at-home edition of Stock Play of the Day, we can't answer them live, but we will address your questions next week if we have that opportunity. So just make sure you put your questions in the chat box, and we'll pick a few of them out to talk about in the show. This one is concerning Google and our pick last week in earnings. So what was the question overall, Lindsay?
Yeah, I think it was just, the question was just about an update on the trade. Do we still like Google after last week's pop on earnings? And I think the answer is yes, because, the fundamentals showed, while they missed on the earnings line, and ad sales did slow, and they fell off very sharply in March. We heard the CFO talk about how ad sales didn't get worse in April. And then also the cloud business was a big standout, with revenues increasing 59%, much better than most people had expected, showing that they're gaining share in that market. It's not a one-trick pony, with AWS winning all of the cloud contracts. Google does have some skin in the game, and they are moving forward with that. And then also YouTube ads there were a benefit for the company in the quarter. So I think these guys are going to be able to be resilient, even if this downturn or slowness in the economic environment does continue for a while. And again, it goes back to what we said at the very beginning of the show, when we talked about the NASDAQ being green today versus some of the other major indices. It's these tech names, these big tech names that are involved in a huge secular growth story, that investors just feel comfortable with going forward. So we still like Google here. And I think it's probably an interesting place to buy into any dip that you find.
Yeah, overall. Okay, so then let's do a quick summary of the market. So the S&P 500 index in general?
Yeah, I mean, today it's feeling a little pressure on the S&P 500 index. It's a Monday morning. We also have that big jobs report on Friday from April, which I think people expect this to be pretty bad. But look, this is a technically driven market. So, a little bit of choppiness in the near term as we finish up earnings season and get a better grip on what the economic environment is going to look like and how we're going to recover from the slowdown that the coronavirus pandemic caused. I think that, makes sense to follow the technicals from here.
All right. And then so with the option strategy, I'm going to kind of emphasize here that instead of going the long call spread route, when you have high volatility, we picked a strategy that will address that high volatility. But as an alternative, you might want to just think about buying the stock here. Even though I am the options guy, sometimes it just makes sense. You have a little bit lower price stock and you have a high implied volatility. If you don't mind the risk and you'd like to be a little bit more long-term on gold, you might just buy 100 shares of it, or whatever your risk tolerance would be in that situation. All right, so that's going to be it for this edition of the Stock Play of the Day. We'll see you same time, same place next week. Don't forget to click subscribe and ring the bell so you get all the alerts. Thanks for coming, everyone.
See you next week.